This week's number, $6.23. That's the average tooth fairy payout per lost tooth in 2023, up 16% from 2022. In other news, I paid $80,000 for my veneers. That's a lot of fucking ZipRecruiter ads. Welcome to Prof G Markets. Today, we're discussing Virgin Galactic's earnings, Amazon's Stock-as-Collateral plan, and the grocery delivery market. Here with the news is Prof G media analyst and natural inspiring smile, Ed Elson.
How's it going? How's London treating you?
I'm back. It's we're in springtime, so it's up to 45 degrees, and the sun doesn't go down till like 4:30. I've had it. No one warned me about this British weather. I just don't. It's really, I can see why they're so like curt and kind of irritable all the time here. It's okay. I'm here with the dogs and the kids. Great to see the dogs. Great to see the dogs. Yeah, it's good to be back. Where are you,
It
Ed?
snowed in New York, so
I
think
heard.
things are better in London, to be honest. But you said you got 12 hours of sleep last night. What happened?
Daddy hit the edibles, slept for 12 hours. I don't remember getting up, which is crazy because I must have gotten up 3 or 4 times, given that my prostate is the size of a Hindenburg.
Oh my God.
But yeah, slept for a good 12 hours, feel much better.
Nice.
Was going to work out, didn't do that. Took the dogs for a walk. That was my big exercise. Anyways, back thinking about, are there any football games this weekend? I need to go to a football game. That's what I need to get me back in the British way of things.
Yeah, I've been not really paying attention because Chelsea's just dog crap.
It's
these
a
days.
rebuilding year.
Yeah.
They've got, what is his name? Fernandez, the Argentinian kid?
Yeah. Enzo.
He's incredible. Best young player of the cup, right?
Yeah, exactly. It's awesome that you know that. You know that from your
And
kids?
the Ukrainian kid.
Yeah, Mudryk.
Mudryk. He was clocked as the fastest player in the Premier League.
Yeah. Great start. That's
Yeah.
right. But
So
he scored 0 goals, so it doesn't really matter.
Yeah, I'm excited, actually. I think that's the rebuilding year for Chelsea. I'll go to some Arsenal games. Did you see the Spurs beat Chelsea 2-0?
I did indeed. It's
and
not good.
The American player on the Rangers, I forget his name, Jensen, I think. Anyways, he left just because he didn't think he was playing well, like some sort of emotional thing. Anyways, a lot going on. I need to catch up.
Yeah, me too.
I need to catch up. What's going on in the news?
Let's start with our weekly review of market vitals. The S&P 500 continued its slide into March. The dollar climbed, Bitcoin fell, and the yield on 10-year treasuries hit 4% for the first time since November. Shifting to the headlines. Inflation in Germany accelerated to 9.3% year over year in February. That's up from 9.2% in January. France and Spain also registered consumer price gains. Tesla is building a new car factory in Monterrey, Mexico. That's its third outside of the US. It's also building a lithium refining plant in Texas. Those were a couple of the biggest updates from Tesla's Investor Day, which actually sent shares down 8% for its lack of news around a next-gen car model. Meanwhile, electric car company Rivian posted negative free cash flow of $6.4 billion for 2022. For context, Tesla had 13 consecutive years of negative free cash flow before its investments started to pay off. It reached a low of $4.1 billion in 2017. And finally, a Bloomberg report showed that earnings quality hit its worst level in more than 3 decades last year. Now, the way they measured this is by looking at the difference between company profits, that is, the amount of money coming in on an annualized, accounting-adjusted basis, and they compared that to cash flows. That's the amount of dollars that have actually come through the door. So profits at S&P 500 companies were 14% higher than cash flows last year, which means that for every dollar of profits, companies are registering just 88 cents of cash inflows. Scott, what are your takeaways here?
So I was disappointed to see that inflation looks like it's having a bit of a, I don't know, either a rebound or I'm hoping it's just a dead cat bounce and then it'll start its descent again. But there's no getting around it. There seems to have been a pop. Bond yields also accelerated. I don't know what explains it. Was there any color or context for why prices have gone up?
I didn't see any unless...
You're just a pretty face reading the fucking headlines. Do the job. If I wanted this, I'd just go to CNBC. Wear a sleeveless dress and put on eyeliner if you're not going to do any actual work. Or be Joe Kiernan and just tuck in Donald Trump every night. Ah! Anyway, that's my impression of Joe Kiernan. Look, the Tesla thing, I listened to his big product day, and what struck me is this is a guy that's distracted. It felt as if the IR and comms people gave him a bunch of talking points the day before because he was more focused on firing people at Twitter than on Tesla for the last 6 months. And it felt like a lot of jazz hands. I didn't feel like there was a lot of there. And I think the market is, granted I'm biased, taking a lot of his statements with a grain of salt because he has a habit of not delivering against a lot of the promises he's made. Now, having said that, I read somewhere that their kind of 0 to a million took 12 years, then 4 years, and now it's like down to 7 months. Mm-hmm. So they continue to operationalize and recognize efficiencies. I just wonder, it just strikes me again in this sense of I think the market is looking for any reason to take the stock back down again. It was at this level about 5 months ago. It crashed 45%. Then it skyrocketed again, making him the wealthiest man in the world again. Now I think it's dramatically overvalued again, and I think we're going to see it come down. But I've been very wrong on this. The other interesting bit here is they're building a factory in Monterrey, Mexico. I believe if you were going to buy, and I might do this actually, if you were going to buy a country or a ETF that's based on a market or a specific geography, I'm very bullish on Mexico. And the reason is that I had this guy, I had lunch with this guy named Jamil Androlini, I think his name is, and he's the editor-in-chief of Politico in Europe. Just a super impressive guy. And he kind of took me through, he ran the FT in Asia for a long time, and he's just sort of ran me through a brief history of China and Xi Jinping's rise to power. And just to be blunt, it's just fucking scary. This guy is literally an autocrat and put tons of people in prison in Hong Kong. Hong Kong has definitely like done a hard turn away from any sort of free speech or democracy. And I think a lot of companies are totally freaked out and are leaving China, and they see just huge risk everywhere. And there's just an enormous amount of conversation around trying to diversify your supply chain. And then the question then becomes, well, okay, okay, there should be some huge beneficiaries when all of a sudden the world's largest factory loses business. The world's largest manufacturer starts shedding market share, and that's China. And I think the two biggest beneficiaries are going to be one, Vietnam, which has some kind of low cost and is actually more politically stable, strangely enough. But I think the biggest beneficiary is going to be Mexico because the largest customer is the U.S. And one of my colleagues at NYU, Pankaj Jemawat, did great research around 10 or 20 years ago. And what he found is that trade is much more regional than you think. That 9 out of 10 times a country's largest trading partner is a country that borders it. So our biggest trading partners are Canada and Mexico. And for me, Mexico offers this peanut butter and chocolate of less regulation, lower wages, but political stability and great proximity, geographic proximity. So I think you're going to see a lot of investment in Mexico over the next several years. Rivian, it is expensive to build a car. It takes massive investment to build platforms. This is a tough business. There's a reason why car companies consolidate. I got to think the majority of these. I read an ad on Pivot for Genesis, which I guess is a new electric car company. You got to think that most of these are going to go the way of Tucker. They're just going to be absorbed, and there'll be consolidation. I don't think Rivian will be an independent company for in 10 years. It's just too expensive. As a matter of fact, even the biggest companies, if you buy a Q7, a Porsche Cayenne, or a Volkswagen Touareg, you're buying the same car. They're all built on the same platform. They just have different finishes and different branding. And the reason why is this is such a capital-intensive business. The only way you can make money is to put a bunch of brands and a bunch of cars or models on the same platform. So that's not a surprise. And then the earnings quality, I don't know what to take from that. I don't know. I'm not entirely sure what that means. If it's a good thing that 88 cents means they're amortizing investments or debt that they've taken out for growth. I don't exactly understand what that means, but it doesn't. Yeah. It feels to me like a bit of a non-story.
Well, I think the idea is it's sort of an accounting story, and what explains that gap is mostly accruals, and what that is revenues that have been earned but have yet to be actually paid. So, for just as an example, John Deere reported $8.2 billion in net income, but only $6 billion in operating cash flow. And the reason for that gap is because of this increase in accounts receivable, and that is, payments that they've registered, but that they can still include in the bottom line because they're going to get paid, but the cash actually hasn't come in the door. And so I think what's going on here is this accounting story where companies more than ever are trying to move cents and pennies around as much as they can to tell a better story with their earnings, when in reality, the cash flows are actually pretty underwhelming.
Yeah, that makes sense. I like your explanation better. So our crack team here at Prof G assembled some data on Tesla, and it took them 12 years to get to 1 million cars, the second million in 18 months, the third million in 11 months, and the fourth million in just 7 months. They have responded to the government's plan for subsidies. The infrastructure bill provides subsidies for EVs under $55,000, so Tesla has responded. What's interesting is that Tesla says they're developing a powertrain that won't contain any rare earth materials. So just as EVs didn't need fossil fuels, now we might be thinking of the next generation of EVs won't require any rare earth materials, which is really, I thought that was super interesting. And then Rivian really did kind of shit the bed. They posted revenue of 663 million versus 742 million. That's about a 10% miss. That's pretty significant. By the way, I'm on the waiting list for Rivian, and I get emails updating me on when I'm supposed to get my. I'm going to look ridiculous in Rivian. You can't even imagine how stupid I'll look in a Rivian. Anyways, gross margins and production efficiency are lagging. See above, a ridiculously difficult business building cars. And Rivian produced about 25,000 cars in 2022 and expects to double that to 50,000 in 2023. And it expects to achieve a positive gross profit in 2024. That will not happen. So Tesla is going to produce 1.3 million cars in 2022, and Rivian produced 25,000. So basically, Tesla is still producing about 50 cars for every one that Rivian is. Isn't Rivian sort of Bezos's, midlife crisis? Date the hot chick, go to space, and start a car company because my dick is bigger than Elon Musk's dick. Is that unfair?
Yeah, exactly.
Is that unfair, Ed?
Well, put another way, they're going to supply Amazon's electric van fleet. I think that's why it became such a hot company, and probably what propelled it to, being so initially well received in the public markets. And then obviously it came crashing down.
Wow, talk about some more cool data from the team here. So there's revenue per vehicle and there's cost of revenue per vehicle. And obviously scale is what brings the cost per revenue per vehicle down. But Tesla has kind of hit that scale. Average revenue per vehicle is about 52 grand and the average cost is 38. And then Rivian, the average price is 82 grand, but the average cost or average revenue is 82 grand, but the average cost to produce a Rivian is $235,000. And then Nikola, the average revenue per vehicle was $350,000. They're getting $350,000 per car, but the average cost to produce each one is 1.15. The bottom line is this is a business of scale. And if you don't get to scale, you just hemorrhage money. But let's talk about stock performance. In the last 12 months, Rivian's down 70%. Year to date, it's off 11%. Ford is up 5%, GM up 15%, and Tesla is up 73% year to date. That's after a pretty serious decline. The bottom line is the automobile industry, there's just a million ways to get screwed. It's capital intensive. It's sort of labor intensive. You need real estate. It's brand sensitive. It's sensitive to the economy. It just feels, and the reason why these companies traditionally, except for Tesla, trade at such incredibly low multiples is the market has just decided in general, it's a shitty business.
Mm-hmm. And just final note on the earnings quality stuff. Do you have any, as I was saying, it's sort of like an accounting thing. People are putting more work on their accountants than usual this year, probably because times are tough. Do you have any experience personally with this business of kind of moving your numbers around on the income statement and trying to inflate earnings as compared to cash flows, or is that never something you've had to deal with in your experience as an executive?
I've been really fortunate. All the public companies I've been on have a chair, basically a board. They kind of show up, talk to themselves. They consist usually of what I call FIPS, formally important people, who want to show up every 3 months for a dinner, provide sage advice. They're kind of gridiron greats, and they get paid $250,000 a year. And there's two or three people on the board that actually matter. One is usually the largest shareholder. One is someone who just has a lot of gravitas, and generally everyone finds themselves nodding when they speak. And then the other really important person is the chair of the audit committee, because that person is the one that sits down with the CFO before the earnings call and says, no, you can't say it that way, or that signs off. And that person is really kind of the heat shield or the Kevlar for shareholders, ensuring that shareholders are getting an accurate picture of what's going on in the company. And I've been really fortunate in the sense that all the companies I've been on the board of have taken a very conservative view of how to report numbers, because in the last few years, a lot of companies, especially private companies, have gotten very creative with the term EBITDA. I mean, all of a sudden, we were kind of led the pack here and came up with something called community adjusted EBITDA, or what I refer to as an EBITDA before everything else. So they decided to take out their real estate costs and include that in something called community-based EBITDA. Keith Robois went on CNBC and came up with a bunch of new accounting terms to try and show that Opendoor wasn't, in fact, a flaming bag of shit. And the host, Deirdre Bolsa, who did a fantastic job of just interrupting him and saying, that's just not true, Keith. You have not been profitable 5 years in a row. This company has hemorrhaged cash.
It'd be like saying, it'd be like saying, look, Apple loses money because they don't charge fees. It's stupid and insane.
But Opendoor does lose money, Keith. It hasn't been profitable on a GAAP basis, right, for the last few years.
Opendoor is profitable on a GAAP basis. If you look at last quarter,
what are you looking at?
For the year, we're going to be GAAP profitable. Almost, I mean, it's hard to tell because quarter four hasn't occurred.
But it's not profitable, Keith. We'll show you the numbers. We'll show you the numbers right on the screen right now. Lost money on a net loss basis in 2021, 2020.
Yeah, you can come up with all sorts of different metrics that position your company in a good light, whether it's growth or whether it's subscriber churn. Companies come up with their own metrics, but I think uniform standards around GAAP accounting, most companies ascribe to. What's interesting is that there's different ways to amortize an expense or an investment. And one of the reasons why Meta was one of my 3 stock picks for 2023 is they have been expensing every investment they've made in the metaverse. And they could have amortized it. They could have said it's a CapEx, and we're going to amortize those expenses over 7 years. So if they invest $15 billion in the metaverse in 2022, they could take a charge of $2 billion over, or $3 billion over 5 years. Instead, they expensed it all right away. Meaning every month.
Why do you think they did that? I mean,
well, they're very conservative. They're very conservative. They have the cash flow. And to Mark Zuckerberg's credit, I think he just wants to be very conservative in terms of how they report numbers. And the reason why, one of the reasons I picked it as a stock buy, the moment they stop investing in this consensual hallucination, big gulp ayahuasca vente dream of Zuckerberg's, all of that flows immediately to the bottom line. So they could, just if they stop today, this ridiculous investment in the metaverse, just the additional profits they would register to the bottom line in the remainder of 2023 would be more profits than probably 400 of the 500 biggest companies in the world.
Yeah.
So the moment they do that, it all goes down. But accounting matters. And in this instance, Facebook's conservative accounting means that when they stop investing in the metaverse, which I think they will do, or they will reduce those investments, it goes straight to the bottom line.
Yeah. Well, we'll just end on this stat. 30% of the Russell 3000, that's the 3,000 largest companies in the US, are unprofitable. And in 1980, that number was 5%. Let's move on to our next story. Space travel company Virgin Galactic reported fourth quarter earnings, and investors were not happy. Net losses almost doubled to $150 million for the quarter. On an adjusted EBITDA basis, that number was $133 million, which missed analysts' expectations. And meanwhile, revenue beat expectations, but the number was basically negligible. It was $869,000 for the quarter. And just for some context, that's 5 times less than what Cristiano Ronaldo makes in 1 week. Virgin Galactic shares fell 16% in after-hours trading. So, Scott, before we look at these earnings, could you just give us the context on what Virgin Galactic actually is?
Well, just to go very meta, it's literally the shittiest business in the world. But what it does is their mission says they're trying to be the world's first commercial space line. And our purpose is to connect people across the globe to the love, wonder, and awe created by space travel. Yeah, fuck you. Anyways, essentially, their product is for $450,000, you can have a 90-minute suborbital journey. And at that price, it's only expected to generate revenue of $2.7 million per flight, meaning it would have to fly 185 times per year to offset its losses. It hasn't done any commercial flights yet, but plans to in 2023. Not going to happen. And the company received more than 8,000 applications of interest, as they say, as of February 22. So Virgin pulled off, to their credit, what I think is probably the most successful PR stunt of the last decade. When Richard went up there and they had cameras showing their trip into space, the whole world was watching, and it was a really dramatic moment. And the entire world knows about this product. And when they say 8,000 applications of interest, that's not how many people have actually plunked down $400,000. So generously, it might be 500 or 1,000 people out of the billions of people that saw this. And companies that are usually one of two things. They're either supply constrained or demand constrained. So most companies are demand constrained, meaning that McDonald's would like to have more people who want burgers. The Four Seasons wants more people to buy hotel rooms right now. They have a lot of excess capacity. I don't know if that's true. Away luggage could handle 1 million more orders pretty quickly. They're not really hard objects to produce. And then we saw a lot of companies that were supply constrained. And that is a Gulfstream G600 is somewhat supply constrained. It's very hard to make a commercial airliner or a private jet. So Boeing and Embraer and strong economies or Airbus are more supply constrained than demand constrained. And there's just certain things you can only make so much of. But again, companies are usually demand constrained more than they are supply constrained. Virgin Galactic is this unique combination of wildly demand constrained. There just isn't that big a market for people who are going to pay $500,000 to go into kind of suborbit. That's just a pretty limited market. And then supply constraint. Space is a dangerous and expensive business. They have not been able to put these things into the air at any regular basis. They've missed every milestone. They're limited in terms of the supply. So this is literally the mother of all shitty businesses. It's just both. I can't think of a business that's more supply and demand constrained at the same time.
Would you ever pay for the flight? I mean, put all your biases aside. Would you be down?
I'm not exaggerating. If someone said every human has to go on Virgin Galactic unless you pay $4.5 million not to go, I would pay $4.5 million not to go. I get motion sickness, and I look at data. 550 people have gone into space, and 11 have not returned, which means space travel is more dangerous than base jumping. And this whole thing goes to zero. I believe this company goes to zero, and it goes to zero one of two ways. One, over the medium term, it's just a shitty business, and people realize it can't justify the revenues are never going to catch up to the expenses. Or two, Bob from accounting gets blown up on the launch pad. This is a dangerous business, and I don't think I get motion sickness. I really am into this whole life thing. I'm just really kind of enjoying it. I'm going to ride this whole life thing out. So I would never. Would you do this? If someone said to you, let's not even say $450,000 because I know how much I pay. If someone said, we'll give you 90% off, would you do it for $45,000?
No, I wouldn't. But I'm in a completely different position from you. I mean, I'm wondering from your position, where you
got
have
less to live for.
Yeah. Well, I would not pay 45. I wouldn't blow 45K on basically anything at this point in my life. But the thing that's interesting is, I don't know, it sounds like it's not the price point that's making you hesitant. I mean, I remember a year ago, you were big on supersonic flights.
Yeah, I still am.
So can you explain how, why is that reasonable to you and then this isn't? It's a safety and danger thing?
I invested $3 million. Was it $3 million? I think it was $3 million in a company called Boom Technologies, which was trying to produce the first supersonic commercial aircraft in 40 or 50 years. There hasn't been supersonic commercial travel since the Concorde's crash. And I think the market is enormous. I think there's a huge market of people, including myself, that would pay $10, $20, $50,000. I came home from London, or I came home from Miami yesterday. 9-hour flight, just absolutely wrecks me in my age. And Boom Supersonic believes that we're going to be able to get people at least from New York to London in 3 to 3.5 hours. I think that's a game changer. I think it's the toll it takes on your body, the fact that it opens up different continents for kind of a long weekend versus a week. And the only thing, I just think there are so many people out there that are running out of time, and because of income inequality, just have so much more money than time that they would absolutely pay. I mean, there's people who pay 150 grand to take a Gulfstream across the pond because they get to decide when it leaves. That's actually a fairly big market. There's quite a few people doing that. So if you said to them, get to Heathrow and we can get you to New York in 3.5 hours. If you leave here at 8 a.m., we can get you there at 6 a.m. and you have a full day, or we can get you home in time to go to sleep. I think that market is huge. And then the progress in terms of propulsion and materials and avionics has been pretty dramatic. So I think it's commercially viable. So the only thing in my life that is not perfect is the amount of time I spend in the air. And I think I'm part of a growing number of people that have the money now that would pay a lot of money to save that kind of time. So I'm a huge advocate. And not only that, after we talked about this before, I love aviation. The guy running Boom is a smart guy from Amazon. So there's no doubt about it. It's a long shot investment. There's a lot that can go wrong. This is complicated technology, but it is dramatically less difficult, less dangerous, and less expensive to fly along at 50,000 feet as opposed to, going into space. It's just an entirely different game.
Mm-hmm. And finally, so Virgin Galactic said that they expect the first consumer space flights to happen in the second quarter of 2023. In other words, now, sometime in the next couple of months. Sounds like you don't buy that.
Yeah, right? And Rivian will be profitable. I mean, that's just not going to happen.
Yeah.
It's just it's an incredibly difficult business. And isn't that now? Do they have a planned launch coming up? I don't think this company wants to do a lot of planned launches. I think this doesn't end well. I'd rather this business end because of shitty cash flows than ends because of a flash. Yeah. So I think this is, and I want to be clear, I was the original hater here. I've hated this thing for a long time. I think anything with the term Virgin on it, whether it's Virgin Galactic or Virgin Orbital, which is actually a better business, is primarily a vessel for transferring money from retail investors to a struggling airline or cruise ship line owned by a very charming and fascinating entrepreneur out of the UK. I think these are shitty businesses, and I have trouble finding any business anywhere that makes less sense than Virgin Galactic. The whole space thing, there's space tourism, which is a stupid business and will go away. There's space exploration, which isn't space exploration, it's space execution. Anyone who's stupid enough to go to Mars is mentally unfit to do anything. And then you have space hauling. And that is actually a good business because there's a lot of technology and utility in putting satellites up into the air, and the ability to haul material and equipment into orbit is going to grow 15-fold in demand. But that all plays to SpaceX. SpaceX has attracted the best engineers and the most capital. I think, my view of SpaceX is going to be worth more than Tesla, mostly because Tesla's value will rationalize. But if you look at Starlink, if you look at the Falcon Heavy rocket's ability to get material into space, what does it cost per kilogram to get stuff safely into orbit? SpaceX, their Falcon Heavy rocket, just beats everything. So, but space in general is really fun. It's interesting to talk about. It's interesting. It's captured a lot of imagination, and CNBC puts, very charming, charismatic people on with Richard Branson to talk about Virgin Galactic as a software company. But yeah, the space is, watch out. Space is, in space, no one can hear you screaming. In space, you lose all your fucking money.
Yeah, well, SpaceX is now valued at $137 billion, and it was just awarded a $1.4 billion contract from NASA. So there is money here, but it's not going to Virgin Galactic. Let's go to Mia on the street to see if New Yorkers would pay to go to space.
So would you go to space?
I would go to space.
And why?
I'd just check it out.
I think so, yes, actually.
I would not.
I feel like it'd be a once-in-a-lifetime experience, so I would do it.
No.
I would also never do that. I feel like space right now is for science, not for tourism. So I wouldn't want to spend my money like that. And also, I'm scared.
I think I would. I think the world as it is right now is going through the most. And especially in my country, I wouldn't mind a little forever trip to space. I wouldn't mind that at all.
I think it was Jeff Bezos who took William Shatner up in space. And William Shatner's reaction, I'm a big Star Trek guy, William Shatner's reaction when he came back to Earth, just absolutely, I mean, that guy was, it was crazy looking at that. It was almost brought me to tears. And I think a lot of us have this dream, so most definitely, I think it would be a tour of the lifetime.
It's a different perspective, right? So you're in a different area looking down at where you normally tread, and I'm sure that there's something really beautiful about that.
Would you go to space?
Hell yeah.
And why?
I ain't never been up there before.
How much would you pay to go to space?
I don't know, 15 grand.
Around 10,000 and
Like 20 grand, maybe?
50,000 I think is my max right now.
And whatever the ticket costs, I'm there. I'm one of them types. If you tell me how much it is, I'll go get it.
$400K.
All right, I'll go get it after I do a few other things.
Oh, you didn't mention I had to pay. I found out the exchange rate is actually 1:18 with the dollar, so...
Really good in space.
Yeah.
How much are tickets right now?
I think $400,000.
Yeah, that's like absurd. Like, go up there. Maybe just stay up there.
And are you afraid of blowing up?
It wasn't until you mentioned it. You know, I'd never thought about the idea of blowing up on the moon until you just mentioned it right now.
I was thinking more in terms of takeoff.
Oh! Didn't even think about that. So now I definitely am not going to space. I will stay home where I'm probably not going to blow up.
Anyway, let's move on to our second story. Amazon and mortgage provider Better.com have come up with a new way for Amazon employees to buy a home with stock. Better.com's new product, Equity Unlocker, will allow Amazon employees to pledge their Amazon stock towards a down payment for home loans instead of using cash. Banks already offer this to high net worth clients, but this program will be a little different in that it will be protected against margin calls. In other words, if Amazon's stock price slides, buyers won't be required to pledge more stock as collateral. However, there is a pretty big catch. Employees have to pledge stock totaling twice the value of the down payment loan. And Better.com will also charge a higher rate on these stock-based loans, between 0.25 and 2.5% higher than standard mortgage rates. There is a nice benefit, and that is that the program is available to laid-off Amazon employees who still have restricted stock units. So, Scott, why are they doing this? Or more specifically, what do Better.com and Amazon have to gain here with this program?
So Amazon has 1.5 million employees, and it incentivizes employees to hold on to their stock. So it's seen as a benefit, right? I work at a company where I can use my stock as collateral for a down payment on a house. That's a tangible benefit. And by the way, I should disclose, I'm an investor in Better.com. I've invested right before the pandemic. So I invested, I think, in 2019. But it's a benefit to employees. And say you have stock options that are 200 grand in the money. If you hold on to the stock and the stock doubles, you not only double your equity holdings, but you doubled it on pre-tax income. One of the greatest tax-advantaged investments in history is the fact that stock grows in value tax deferred. And so that's powerful. So if people believe an Amazon stock is down, whether you think it's cheap or not is subjective, but it is down. Maybe people think, well, I finally built up some stock. I think it's going to do really well. I don't want to sell it, but I want to buy a house. And I'm willing to take a bit of a hit and pay additional mortgage interest. But this is just, simply put, a bet on the stock price.
Right. So they're saying that there's this 0.25 to 2.5% premium that you have to pay on the regular rate. And regular mortgage rates in Seattle, as the example, are around 8%. So let's assume that you're paying 9% on that down payment loan, and you've pledged the Amazon stock as your collateral. I guess for the first few years, the 9% makes sense. But, ultimately, aren't you going to sell your Amazon stock at some point anyway? Like, when would this make sense, in your opinion?
So you got to think like a rich person. And this is how rich people think. Never sell, just borrow against your stock. Let the stock continue to grow. If you think that the stock's going to continue to go up and the natural trajectory of the market is up, you should always look at your portfolio and make sure you're not too concentrated, because when you work somewhere, you're investing your human capital. So to invest your human capital and the majority of financial capital in one entity, that's not something you want to do, especially as you get older. And you want to look at whether or not you're diversified enough. But this is, or what employees are saying is, I don't want to de-risk my Amazon stock. I'm comfortable with what I hold, and I'm going to borrow against it.
You mentioned you're an investor in Better.com. Could you just explain why this business was attractive to you, how you got involved, your experience there?
So I co-invest with venture capitalists, where I think that the principal or the partner is someone that I know and trust and I think is very smart. In this case, it's a venture capital firm called Activent that's sort of got the hot hand right now. They've had good years even when other VCs are struggling. They just, I think their big exit was Deliver, the company that just got bought for $2 billion. Anyways, pre-pandemic, they gave me an opportunity to invest in this online mortgage company called Better. And the CEO there has this vision where he said, look, mortgages are still a very complex, labor-intensive product. And how can we use technology to automate and routinize a lot of that process such that we can get people answers faster and then pass that savings back to them? And once interest rates start coming back down in the mortgage market, the mortgage market's been a terrible business the last 12 months because people don't want to borrow or people don't want to refi when in an accelerating interest rate environment. But I like the idea of using technology to try and reduce the costs of something that can be then passed along to the consumer, in this case, the person taking out the mortgage. I did a call with my quote-unquote financial advisor. I have a financial advisor for the first time in my life. And he said, if you have a liquidity event with one of these crazy private investments, you may want to think about paying down your mortgages. And I thought, what are you, crazy? It's the best interest rate ever. And he said, not any longer. You're going to have to refi. I have a couple 5-year mortgages and they're all coming due next year. And he said, they're going to be more like 6% now. So you may want to consider paying them down because it's no longer just cheap, free money. It used to be borrow as much as you could of something like a mortgage or a margin interest rate because the interest rates are so low. That's no longer the case.
What was the rate that you were paying? That you are paying?
I have 5-year mortgages on my places in New York and Florida, and I got them at 2 3/8, so 2.375. Which is effectively free money. Yeah. Unfortunately, now I'm kicking myself that I didn't go out 10 or 30 years, only went out 5, so I've got to refi them in 2023 and 2024. Anyways, Ed, you should have told me. This is your fault, Ed.
Okay, let's move on to our next story. According to an internal investor memo, grocery delivery startup Instacart had a hot fourth quarter. Revenue increased 50% from a year ago, and gross profit rose more than 80%. For the full year, revenue came in at $2.5 billion. Instacart is also preparing to go public in the next few months. The company filed for an IPO last summer, but ultimately pushed back those plans due to poor market conditions. So, Scott, there was a lot of speculation last year that the COVID grocery delivery boom wouldn't last, and that was especially reflected in the markets. You had all these rapid delivery companies that were shutting down their operations. DoorDash stock came down 70% last year. Even Instacart's valuation was cut by around 70%. But these numbers feel like it's delivery's redemption. So do you think this grocery delivery boom is actually going to be here to stay?
It does feel as if grocery delivery is one of those enduring features of a post-pandemic world. Between Q1 and Q2 2020, Instacart's revenue grew 157%. In 2020, average quarterly year-on-year sales growth was 236%. But unlike some of the other e-commerce growth, it doesn't appear to be a pandemic blip. Instacart hasn't been able to sustain that kind of growth, but it's still growing. In Q1 2022, Instacart sales were 4% lower than in Q1 2021. And customers are spending slightly less on each order. So it accelerated dramatically, and the sales aren't growing now, but they're holding. And total U.S. online grocery sales are forecast to grow at a CAGR of 11.7% over the next 5 years, increasing online share of overall grocery spending from 11% in 2022 to 14% in 2027. I remember thinking that grocery was the last holdout in e-commerce. It was like 2% of grocery was done via e-commerce, and now I think it's accelerated to kind of where the rest of most of retail's categories are. Also, you've seen sort of a culling of the herd. A lot of these last mile delivery companies that felt very Cosmo or Webvanish have gone away, that they were just eating so much capital. Mm-hmm. And these guys feel like, I don't know, you want to call them the Airbnb or the Uber, that space. So this feels like, quite frankly, these guys just feel like, from what I can see, a juggernaut, and the ones that have the scale to get to profitability and to get the best talent and the most capital. So this feels like it could be a watershed or a turning point in the IPO market. And the IPO market needs something. In 2022, IPO proceeds fell 70% compared to 2021. And in the US, IPO deal proceeds declined 94% in 2022 from $156 billion to, get this, just $9 billion. In 2019, Uber alone raised $8 billion in its IPO. So this Instacart is not only important for growth, important for the IPO market, it could be important for the entire market. The whole world or the whole market is going to be holding its breath if they decide to try and go test the waters of an IPO later this year.
Yeah, I mean, some of the data, I mean, we don't have that much data on the entire food delivery market, but if you look at individual company performance, things are going really well. So Uber Eats grew its revenue 30% in 2022. It went from 8.4 billion to 11 billion. DoorDash grew its delivery revenue 35% in 2022. And, you know, that's compared to insane growth from 2020 to 2021. I mean, both Uber Eats and DoorDash had those revenues either doubled or more than doubled. But it still feels pretty remarkable that you're still seeing some growth in this market when it felt like, I don't know, I felt at least that I didn't think that I would ever deliver food again once I was able to get outside and go to restaurants and go to the grocery store. But that actually hasn't been the case. Like, I still get delivery all the time. Has your experience been similar?
I haven't been into a grocery store unless it's to buy like alcohol late at night or Advil the morning after the alcohol I purchased. I mean, I just don't go into grocery stores. And people talk about, let's look at this. Let's look at the EV market and let's look at home delivery of grocery. And I think what people are missing is that it's essentially being driven by how bad the channel is. What do I mean by that? The only reason I'm going to buy an EV, I don't like the feel of an EV. I love the throaty, macho feel of an internal combustion engine. It just makes me feel strong like bull when I put the hammer down in an internal combustion engine. I just like it. But the reason I will get an EV is, one, I like to think that I'm somewhat socially conscious, although that's not really leading it. But the number one reason is the worst retail experience in America is gas stations. I've always thought this is where I get shot. I don't know where I am, but I pull into a gas station. It's got the shittiest food, the worst retail. The thing doesn't work. It smells like carcinogens seeping into your body from everywhere. And it's just a terrible experience. And so the liberating moment when you have an EV, the aha discovery moment, is when you realize you haven't been to a gas station in 6 months and you never need to go back. I mean, it's literally freeing. You know, if you think, okay, it takes you 15 minutes to go in, get your gas, pay, and you go into a gas station once a week, I mean, you're talking about 12 hours of an awful experience a year. And then what's the second worst retail in America? Grocery stores. The majority of America does not shop at Whole Foods. go into the majority of grocery stores and spin you around. And I call it the 1980s test. Go to the center of the store, put a blindfold on, spin someone around, take the blindfold off, and ask them how long would it take for them to know they're not in 1980. Same stupid cereal brand, same depressed workforce wearing stupid vests with a bunch of pins on them, same bad lighting, same cart that has a wheel that takes you off to the left. It's just grocery stores have literally, in my view, for the most part, not innovated, and they are difficult, hard to park at. I never need to walk into a grocery store again. And so I think this is a category that will endure, and home delivery or grocery just makes a ton of sense. I think it's here to stay.
And then you were mentioning the IPO market. So yeah, it basically just died in 2021. There were 181 IPOs compared to over 1,000 in 2021. We've had so far in 2023, there have been 23 IPOs. That's not many at all. And none of them have been very large, or at least large consumer facing companies. And Instacart seems like it is that sort of consumer, well-known brand. Do you think that has an effect on the fact that it's such a consumer-facing company will have an effect on its ability to sort of revive the IPO market? Does that matter at all?
Yeah, because we relate to these companies that we touch and feel. Consumer brands do get outsized press and media attention.
Yeah.
But yeah, the IPO market, I mean, we've just had to digest so much shit. Anything that had a pulse got public, and anything that even didn't have a pulse got public. Mm-hmm. And the market is trying to churn through those losses. And then finally, when it gets off its heels and onto its toes again, and the IPO market opens up, which I think is going to happen in Q3 or Q4 of this year, the companies that this time survive the culling are going to be really strong companies. Mm-hmm. So the market got way out over its skis, let a bunch of just ridiculously lame and uncool companies into the club called the public markets. And then the whole place caught on fire, and we're just trying to repair it, figure it out. But there's a line outside, and slowly but surely, I don't know where I'm going with this metaphor, there's going to be some good companies that deserve to be public. And the interesting thing about the markets is what you have to realize, and should give you humility as an investor, is that market dynamics will always trump individual performance. You can be a shitty company and get public in a great market. You can be a great company that can't get public in a bad market. Market dynamics always trump individual performance. So there are some really good companies lining up here. There's this one, Panera, a company I was on the board of, is a great company that's growing, really strong margins. They're kind of at the starting gate thinking about an IPO, but now it's up to the market. The ball's out of everyone's hands. It's really when the market says, okay, there's institutional investor appetite for a new name.
Didn't Panera used to be public? Am I getting that right?
Yeah, they did, and then they were taken private, and then they merged with Einstein and
Caribou.
Is it Caribou? That's not Caribou. I gotta get that. Oh, Caribou Coffee. Yeah, you're right.
Yeah. Okay.
Yeah, it was taken private by a company out of Germany that's by a really well-run company called JAB, and they've wound it up, or they purchased Einstein Brothers Bagels and also Caribou Coffee. But Panera's I don't know, I would argue sort of the crown jewel. Anyways.
So what does that look like? I mean, you're on the board of Panera. What does it look like from a board member's perspective when you're preparing to go public? Are you just sort of kind of twiddling your thumbs and waiting for there to be interest, or are you actively seeking capital from institutional investors? What does that look like from your perspective when you're about to go public, you're ready to go, but you're just waiting for the tide to turn?
Well, it depends what kind of company it is. In the case of Panera, there's not a lot to be done, and it's fine. The company's cash flow positive, EBITDA positive, and it's just a great company. The market will come. Don't worry about it. Just continue to grow, continue to innovate. So it really doesn't impact the company much, other than the CEO and maybe the board hear from their bankers. The CEO probably hears from them every couple months, and the board hears from them every 6 months just to get kind of a market update. Mm-hmm. But for the most part, when it comes like that, it's profitable, it's growing. It's just keep your head down, keep executing, and the market will take care of itself, and you'll know when, and your bankers will tell you when it's time to go public. Mm-hmm. In the case of a company that's growing fast but is eating cash, is cash flow negative, it changes. You have to go raise more money in the private markets.
Right.
So that is a little bit more, that's more, okay, we have to raise money. At the end of the day, an IPO should be a fundraising event or a liquidity event for existing shareholders, but also as a means of raising capital.
Right.
And when you're a company that was planning to go public and the market closes, all of a sudden you're caught, okay, we have to go raise more money. And a lot of these companies, including Instacart, that eat cash, had to go raise money at lower valuations. That's fine. And then when the market opens up, the bankers will come and say, this is the type of company that we think the markets would love. And everyone will hold their breath on the first few that go out to see how the market responds. And that'll set the tone for the rest of the year. So it's going to be very interesting. And this could be that company. This company's numbers are strong enough. It has enough awareness that it could kind of set the tone for the market for a couple months. This will be an important IPO or non-IPO.
And just I don't know if you can speak on this, but why does Panera want to go public? If you're already cash flow positive, EBITDA positive, the business is fine. And as you said, an IPO is ultimately it's a fundraising event to go and do something else. Why does Panera care?
Well, capital's a great thing. You can grow the number of doors. You could go acquire other brands, but also investors want liquidity.
Yeah.
Typically, the public markets will pay a greater multiple than you can get in the private markets. There's a private to public bump. So the existing shareholders, including the employees, can sell their shares right now in the private market, and the owner makes a market in those shares. But if it's trading at, call it 8 to 10 times EBITDA, typically the public markets will give it a 10 to 12 times EBITDA because of the liquidity of those shares, because of the regulatory scrutiny that's been applied. So you have more certainty of what you're buying. So there's a premium to be paid and to be registered with public stock. So over time, most companies decide that the most efficient way to continue financing their capital needs and also to reward current investors is to create liquidity and a certain level of trust and certainty around a publicly traded stock that has certain regulatory requirements. And therefore, most companies decide at the end of the day that the best way to get liquidity and finance future growth is with an IPO.
Yeah. Okay, thanks, Scott. Let's take a look at the week ahead. We'll see January's trade balance and job openings data, as well as the unemployment rate for February. Fed Chair Jerome Powell is also heading to Congress to testify on the current state of federal monetary policy. Powell makes that trip twice a year. Do you have any predictions for us?
Well, the obvious one for me is I think Virgin Galactic is going to zero. I think this company will go through a restructuring. It'll be sold to somebody for its IP. It probably has some IP in there. Maybe they sell it. I don't know who they sell it to, but I just think this thing is just, anyways, enough said. But a more interesting prediction is just, I was talking to you and going through this data. I think in Q3 or Q4, you will see Instacart go public, and I think the market will be very receptive. There's a lot of secular wins at the back of this company. It seems to be a well-run company, and I think the market by Q3 or Q4 will have a lot of appetite for a recognized name in kind of the new world order, if you will, and this kind of fits all of those things. So my prediction, I'm very, very bearish, even though Virgin Galactic has gone down 90%. I think it can go down another 90%. And I think Instacart is going to potentially be the EpiPen to the IPO market in Q3 or Q4.
And no Virgin Galactic space flights in 2023? Can we hold you to that prediction?
Yeah, that's just not... Oh, let's bring in Claire. Claire seems more adventurous than either of us. Claire, would you go on Virgin Galactic?
No.
Okay, say more.
I would go to space if I had that opportunity, but I don't think I would pay any huge sum of money for it, especially not
$5,000?
No.
What's your number?
I don't, but here's the thing, like I don't really trust Virgin Galactic or like want to go with them. Or, I don't want to do like space tourism. I want to go with NASA,
Yeah.
Like I want to be a citizen of NASA or something like that. But I wouldn't like pay that company to take me up there.
So you're like every girl I met. You're like every girl I met in New York in the 30s. I'd love to go to St. Bart's, but I'm not going to pay. As long as someone else is paying.
Yeah.
Exactly.
I heard that a lot.
If the government pays, let's nationalize space tourism.
There you go. Thanks, Claire. This video was produced by Patrick Warren. Our producers are Claire Miller and Jason Stavers. Olivia Rainey Hall is our art director. Sarah Shu is our animator. And George Carty is our video editor. Thanks for watching. Please like, subscribe, and tune in next week. And check out our Prof G podcast on Thursday for a conversation with Liz Ann Saunders, Chief Investment Strategist at Charles Schwab & Co.